being a teacher, like with teaching their kids and stuff. All right, well, let's get started. Just a little bit about me. So this is Mortgage Basics. So a little bit about me. I've been licensed since 2014. Um, got my mortgage license in 2018. I actually left. I worked for Remax for 4 years, and about the fall of 2018, I was kind of burned out a little bit with stuff, and was on a team that was making some changes. So went and got my mortgage license, and let me just say it's a very hard exam. So if you're your lenders who work for more the independent non-bank non-credit union type people, they've all had to pass this exam. So most of the people that work at the banks, they don't have to take this exam, this mortgage exam, the state exam. um, it's a very hard exam. I looked at the material in April, didn't look at it again until August, and let's just say, like, I got like in the 90s on my real estate exams, and I barely passed this mortgage exam. So it's a really hard test. Worked for a guaranteed rate for about 5 months, and then the guy I was working under, he left and started a branch up in Delaware for Revolution Mortgage. I don't know if any of you guys have heard of Revolution, but they're kind of growing here in Columbus. Also used to work for Wells Fargo doing a lot of HELOC, home equity lines of credit, and then I have a financial planning degree from Ohio State University. Um, so let's get started. I have a question, and if you guys have questions or anything, feel free to interrupt me, or we can go back and forth. This doesn't have to be like a really boring thing. A lot of times finance can be kind of boring. But question, what's the minimum score required to obtain a mortgage? Any
Average,
thoughts?
average,
Just in general, the minimum, that people are going to be a need that's required to get a loan.
650, 700.
Okay. Rob, you got anything? Amanda, you have anything?
I don't. I'm sorry. I don't know.
Oh, okay. You're fine. So it's kind of a trick question. There actually is no federally mandated minimum requirement to obtain a credit score or to obtain a loan. So it's kind of a trick question. However, with that being said, and most lenders are with FHA, are going to require at least a 580 or higher. And I don't know if any of you have talked to your lenders the last couple of days. Even typically, most of them with FHA were requiring about a 620. That's actually probably going to change. It's going to go up to probably 640 or above, at least. And the jumbo market, from what I've been hearing, is pretty much going to be it's pretty destroyed right now. So you'll probably see this go up. A lot of times, with FHA, they can do a 580 with 3.5% down. There are companies out there that can do a lower credit score, but you're typically going to have a little bit more down than your typical 3.5% down for FHA. So let's take a look at credit scores. And the reason I kind of go into this is because when you're talking to your clients and stuff like that, these things are going to come up in terms of like, hey, your initial conversations when you're sitting down at a buyer consultation, they're going to say, well, I've got this score, what if I do this and what if I do that? You don't have to be the ultimate source of knowledge. That's really where your lender partners come into play. But just having a general basic understanding of this information will put you in that spot as the leader and kind of the go-to person. So, what affects your credit score? So 35% of your credit score is from your payment history. So that's why they say if you really, really, try to, always pay your bills on time, your credit cards, things like that. 30% is the amount owed. So there's, if you have your, it kind of comes into the whole debt to income ratio. So 30%, if you owe a credit card, let's say you have $1,000 credit line and you owe $500, well, you're at 50% of your credit limit on that credit card, which can impact your score in a negative way. 15% is your credit history, so how long you've had that trade line open. 10% is just new credit, like any new lines of credit that you open. And then 10% is going to be the type of credit. So when lenders are looking at, they want what they call quote trade lines. They typically want 2 to 3 trade lines. So, a car loan is going to be different than a credit card, which is going to be different than, a Macy's credit card. Typically what you see, and sometimes a lot of people, let's say you go shop at Macy's for some furniture and they say, well, we can give you a Macy's credit card and we can put the furniture on there and, you'll pay 0% for 24 months or something. A lot of times that's probably not the best idea. And the reason being is that when let's say they give you, they give you a 5,000 credit limit. Well, let's say your furniture is $5,000. So you put all that furniture on that credit card. Well, what ends up happening is you've essentially maxed out a credit card. And so you're at 100% utilization on that credit card. And so that can actually drop your credit score. So, that's why a lot of times you'll see somebody who's like, man, I just got a credit card from Macy's and, we put our furniture on there and stuff like that. We've been paying on it, but my score went down. Well, it's mostly because you just essentially took a credit card and maxed it out. And so that's actually going to report negatively to, the credit bureaus. So what do lenders look for? Typically, they want 2 to 3 trade lines with a solid payment history. They will pull what they call a tri-merge credit score. So they're going to pull from Experian, Equifax, and TransUnion, and they're going to go off the middle score for an individual, and they're going to go off the second lowest score for if it's a couple who are borrowing. So they always have to kind of go on that lower score of the 2 borrowers. So if you have an individual buyer with a 600, a 650, and a 700 credit score, they're going to go off that 650 credit score. The 1003, you'll hear lenders say that sometimes. It's essentially the application that lenders do. Now, this is all typically going to be online or over an app, but it's the entire form of income, what debts they owe, things like that. Any questions so far? Nope. Okay, cool. So as you know, there's 4 different types of mortgages. There's the FHA, or most essentially what we'll see, FHA, conventional, VA, and USDA. So let's start with FHA. Now obviously you don't have to be an expert on this, but I always tell people, like, you need to understand a little bit of how to roughly estimate, what a payment's going to be. So what I always do with my clients is say, this is a rough estimate, but let's really talk to your lender and get a really, let's narrow down on the, on what the actual amount's going to be. So FHA, and let's see. So credit scores typically, and again, this is going to be changing with all this stuff going on right now in the markets, but it's usually better for home buyers with a lower credit score than 680 to 700. Typically, they'll need about 3.5% down for their down payment. When you're writing the contracts, you're asking for seller credits, and then obviously in this market, it's been a little bit harder to get seller credits, and a lot of people aren't even looking at FHA offers right now, but you can actually get a max of 6% seller contribution. So whatever the purchase price is, so if it's $200,000 purchase, you can actually get up to $12,000 from the seller in seller concessions. Now, obviously in this market, it's probably not going to happen, but the reason, and I think I go into it here in a little bit, but I'll skip that. But when your buyers are doing FHA loans, there isn't also so they have the monthly mortgage insurance, which you guys, you have your mortgage insurance to help in case they default. That's set by HUD, the Housing and Urban Development. They set that rate, okay? But your buyers also have to pay what they call an upfront mortgage insurance premium, and that's 1.75% of the loan. So you can see with FHA, it's good because they only have to put 3.5% down. But if their loan amount is, 197,000, well, take 1.75% of that, and they have to bring that as well, or that's at least the amount that they have to include in their down payment. Now, typically what most people will do is they just roll that into the loan, okay? So let's use an example, and actually right here. So purchase price is 200,000, and the property taxes, I just use 2%. So we've got 3.5%, and that's $7,000. So that's typically the amount that they would, their down payment amount. Now, obviously, there's going to be title fees and some other things that they'll have to pay for, but just for simplicity's sake, we'll use 7,000. So the loan amount is 193. So their upfront mortgage insurance that they'd have to bring is an extra $3,300 for FHA. So, and then their monthly, the way we calculate the monthly mortgage insurance, and again, this is really going into detail that you really probably don't need to know, but it's kind of good information to just kind of understand. So you take that rate that is set by HUD and you multiply it by the loan amount, and and then you divide it by 12, and that's how they come up with your monthly mortgage insurance amount for FHA. So next loan, let's look at VA. Obviously, VA is strictly for men and women who served in the military. So what are the requirements for VA? There's no down payment, which is awesome. Now, just keep in mind that doesn't mean that there's going to be no money out of pocket, okay? So just because they hear no down payment, well, there's still going to be other fees that they have to pay for. The nice thing about the VA is that there's also no mortgage insurance required. So if you have a client who's served in the military, definitely go straight to the VA loan first before checking any other place. There is a funding fee that's required from the VA, and it really depends on if they've used the VA before, what branch of service they were, like if they were active duty versus reserve, National Guard, Reserve, because the funding fee requirements do vary depending on if you were active duty or reserve. Typically, your client is going to need probably either their DD-214 or their certificate of eligibility, which they can get from the VA office. And most of the time, VA is typically going to require, at least here in the state of Ohio, they're going to require a pest inspection for termite, that kind of stuff. And here's a little kicker too, is the buyer, the VA, the veteran can't pay for that pest inspection. So it's kind of an interesting little side piece of information. Conventional. Oh shoot, let's go here. So the down payment amounts. So you'll typically, if people only have a, 3% or 5% down, they'll think, well, I can't go conventional. Well, that's just not true. Typically, your down payment amount for conventional is going to range anywhere between 3% down for first-time home buyers, all the way up to 20% typically, or more if they wanted to. The reason you see typically at 20% is that that's where the cutoff is to not have any private mortgage insurance. On conventional, it's 3% for the max seller contribution, so half the amount that you can get with FHA. this is something that is pretty neat, and you'll see sometimes where people are like, well, I want to reach that 20% down payment so that I don't have, I don't have to pay mortgage insurance. Well, sometimes they can actually put down 15% and buy their PMI out, and it might actually be cheaper than having to put 20% down. So, if you take a $200,000 loan and you're putting 20% down, well, that's $40,000. Whereas if you take a $200,000 deal and you put 15% down, so that's $30,000. So there's a $10,000 difference in what they have to bring to closing. Well, at 15%, they're going to have mortgage insurance, right? So what they can do is they can buy themselves out of that mortgage insurance for a lot cheaper than $10,000. And I think I've got an example here on the next couple slides that'll show that. So here's why sometimes your lenders, even though your clients have money to put down, here's why everybody thinks conventional is the better way to go all the time. And that's just not the case. So here's why. The private mortgage insurance. The private mortgage companies, they set their own risk. It's all based on risk, okay? So if somebody has a 620 credit score, they're probably a higher risk typically than somebody that has an 800 credit score. And so other things that affect it, and I think I go into this later on, I'll have to check and see, but other things that affect that are, how many people are going to be on the loan application, and how many people are, how much you're also putting down. So all those factors affect the cost of the mortgage insurance. And so if you have somebody who's a higher risk, it's actually probably better to go FHA than it is to go conventional. It just kind of depends on how much they have down and where their credit scores are at. So that's where having a good lender who can run the differences and the scenarios can come into play. So let's go on to the next one here. And I give an example of a $200,000 purchase. So same as the FHA purchase that we had before. So again, the PMI rates are going to vary based on how many borrowers, the property type, and the down payment amount. Like I said, it's all risk-based. So let's take a look at a buyer who's putting 3% down, and typically that's going to be a first-time home buyer, and who hasn't owned a home in the last 3 years, and they have a 750 credit score. So the rate is this 0.69%. So as you can see, if you remember with FHA, it was 0.85%. So that's a lot lower than the FHA amount. So let's just take a look. We got the $200,000 purchase with the down payment amount, and that gives us a loan amount of $194. And then we multiply that 194 times that rate, the PMI rate up here, and that gives us $111 a month. So if you compare that, our FHA amount was $136, and our conventional rate is only $111. So there's definitely a little bit of savings there, roughly $25 a month. The only thing, and the thing is too with conventional, is that your mortgage insurance will drop off eventually on conventional, whereas FHA, it's on the loan for life. And so you can never get out of paying this $136 unless you refi. Whereas this will drop off. It's typically probably changed a little bit with how quickly the prices have risen in Columbus, but it's typically about 8 to 10 years once you reach that 78% mark on loan to or debt to equity amount. So then let's go talk about USDA. And obviously here in Columbus, we're not going to see a lot of USDA, at least in central Ohio. But as you start to get out into places like London or Newark or Delaware County and Pickaway County, things like that, you'll start to see a little bit more places where you know, where you can do a USDA. And I made a little bit of joke, farmers only, just kidding. So these work a little bit better when you're in person. But so let's look at USDA. USDA, it is a government loan, and what it is essentially for is to get people who live on the outskirts of town and rural areas to help them with financing on purchasing a home. So there's no down payment required. They must meet income eligibility, and there is an income limit based on the household size. So this is a loan where they're going to ask, you know, how many people are you married? How many people are in your household? Again, the house must be in an eligible area for USDA. So if you work a lot in, you know, areas where there's going to be a lot more people, you know, rural areas, you can check the USDA website and you just type in the property address. For example, I have a listing right now in Marengo, and it qualifies for USDA. So, you know, all you have to do is you just go to the USDA website and you type in the property address, and it'll let you know if it's in an eligible area or not. You'd be surprised. So when I was doing mortgage lending, we actually had a guy who was licensed in Florida, and I think it was like right around Fort Lauderdale or something. There's actually an area right in Fort Lauderdale that is always there, that's USDA approved. So it's not always, you know, these far out places out in the middle of nowhere that are eligible. There's actually some weird areas in Florida that qualify for USDA that are almost inside city limits. So it's kind of strange how that works out, but typically for the most part, you're going to see, you know, more rural areas with USDA. And then they also typically do look for just a little bit higher credit score. Typically, you're going to be about 640 or above. The other thing with USDA is it's really lender dependent. So like, make sure you get a lender who really knows these, especially USDA. You know, if you get somebody here in Columbus who's never done them, they can be a little bit trickier. So make sure if you're going to do USDA, make sure your lender, you know, can do those and knows the programs, because there's some lenders who that's all they strictly do and they know them inside and out and they can close them in 30 days or less. And there's other lenders who ask for 45 days at least to get these things closed. So just talk to your lender about it. So I just want to talk a little bit about credit improvement. And the reason being is sometimes you're going to get buyers who need some, you know, some credit improvement. Maybe they, you know, went through a divorce, or maybe they had a bankruptcy from, you know, medical bills, or, you know, they lost a job or something. And I think this is going to be huge right now, not to sound like Donald Trump, but this is going to be big right now in terms of coming up here in the next year or two, probably next 2 or 3 years, is knowing and understanding credit. So when I got into the business in 2014, you know, things had kind of started to come back up. You still saw a lot of people who, you know, from 2008, 2010, you know, we're still trying to work on their credit or trying to improve it. So this is going to be a really big thing coming up here. I feel in the next couple of years, you're going to probably see some people, unfortunately, who lose their jobs and possibly go through, you know, a foreclosure, or, you know, just can't pay bills, have to go through a bankruptcy, things like that. So I think you're going to see a lot of lower credit scores where you're going to have to work with people who need help. So one thing that your lenders can do is they can do what's called a rapid rescore. And what the rapid rescore is, and this is really where you as the consultant, the agent, the go-to person, I feel like you really need to know, have an understanding of the credit, because, and I'm going to give you an example of probably 2015. I received a phone call from a buyer, and she's like, well, we've been turned down by two different lenders. And I said, okay, well, tell me a little bit what's going on. And so the team that I was on originally, we did a lot of credit repair and a lot of credit improvement with people. Well, she kind of told me her situation, and just knowing, having a little bit of knowledge about, the finance and credit stuff, I said, I don't think that's right. Let me get you over to my lender, and I think we can get you pre-approved. Well, sure enough, the lender takes a look at everything and says, no, I can get her pre-approved. Um, and I don't know if anybody remembers back in 2015 when the lenders made, or 2016, I think, when the lenders made some changes regarding student loans. They started counting a little bit more student loans into your monthly payment. So I knew at the time, I'm like, well, this hadn't gone into effect and this and that. So long story short, we were able to get her approved, and they bought a home, and actually now they're talking about selling it and buying a different one. So, and they've referred me to several people who have bought homes as well. So just knowing a little bit about credit can help out. So your lenders can do what's called rapid rescore. Now, don't go to your lender every single time and be like, oh, can you do a rapid rescore with this person? You know what I mean? Like, don't advertise that you're the go-to credit person, because it does take some time. Your lenders have to calculate, okay, what can we get their credit scores up to, how long, and it does cost them money to use these programs. And so, if you have a good lender that you work with all the time, and if you, every once in a while you run into this, it's fine. I think you're going to start seeing a little bit more though with what's going on in the world right now. So I think they're probably going to get used to it here in the next couple of years. But so the rapid rescore, what they can do is they can rescore the credit with the bureaus with less than 30 days. And what that does is it actually increases the credit score. So for example, my parents just closed on a home, and their credit scores were like right around 680. However, sometimes getting up a little bit higher than 680 can put you in a different tier in terms of, getting a better rate on your loan. So what my lender did, he ran a scenario where he said, okay, what's going to happen to the credit score if I do a rescore and we pay something off? So they were able to pay down a credit card and get a higher credit score within 7 days, and they were able to save a little bit on their rate. They can also do what's called a what if scenario. And so what this does is it pulls in all the client's debt. And so let's say they have like, a car payment, 2 credit cards, and a student loan. Well, what it can do, let's say they're at like a 580 credit score and they have to get to a 620 credit score. What the what if scenario can do is it gives you a really close analysis of how much on each credit card they need to pay down and how long it's going to take for that credit to get to that 620 score. So it's a really powerful tool that your lenders have access to. And it can be the difference between, if somebody's like, well, I can't get approved now. And so really what it does for you as an agent is it kind of just helps increase your pipeline, 5 to 6 months from now. Because typically most people are going to need about 5 to 8 months to fix their credit, if they have something going on. So there's 2 things that really help with credit improvement, and that's time and money. So if you've got a lot of money you can throw at it, that helps. And then obviously the more time that goes by, the better off they can get their, or the higher they can get their credit score. And like I said, your lender can do both of these things for the clients at no cost. It does cost the lender money when they run these programs, but again, I've got a really good relationship with the lender who, and I'm sure everyone here does, and so they're willing to do it for me. Just don't go out and advertise it to the public in terms of having 30 to 40 people that need rapid rescores, because your lender might hate you for that. I want to touch briefly just on down payment assistance. So I don't know if anybody's familiar with these or if you've used these, but these can be really good programs. You can use them with all 4 different loans. You can use them with FHA, conventional VA, and USDA. So example, you don't actually have to take down payment money. So for example, the listing on my parents' house, they actually had enough money. They had 10% down payment, and they still ran it through OFA, which is the Ohio Housing Finance Agency. they actually ran the loan through OFA to just get a better rate. So they didn't take any money from them. They just ran it to get a better rate through OFA. So the does not have, let me see, first does not have time limit. Oh, sorry. This is I see what that's supposed to be. It's supposed to be first communities. So there's typically two different down payment assistance programs that your lenders will have access to, or at least these are the main ones. So OFA and First Communities. And so the First Communities, the reason I like that one is that it doesn't have a time limit like OFA does. So those buyers don't have to stay in that house for, I think it's now 7 years with OFA, whereas OFA has the time requirements. So if somebody buys an OFA house and they get the down payment assistance, well, they have to stay in that house for 7 years. And if they sell that house before the 7 years, they have to pay back that loan on that program. And it used to be that they prorated it. I believe they've changed it now to where you have to pay back the entire amount. Check with your lenders on that, but I think they changed that recently. With down payment assistance, I would advise, and check with your lender. It depends on how good your lender is at doing these, but typically they're going to need a little bit more time to run it through underwriting and stuff, just because they have to go through two different underwriting programs. They have to go through, their bank or their mortgage company underwriting, but then they also have to run it through the OFA or the Communities First underwriting. And so you're going through two different underwriting programs. And so that's typically why on down payment assistance, you'll typically need just a little bit more time, probably about 40 days. It used to be about 45 days, but I think most lenders have gotten so good at it that they can get it done anywhere between 30 to 40 days. And then obviously some lenders, if they're really good, they can get them done in less. But, try to give them a little bit of time to, especially right now, to give them a little bit more time on these contracts with the down payment assistance. And lastly, so you'll probably hear, sometimes you'll hear your lender talk about DU or AUS when they're trying to get your clients approved. They'll say, well, I'm trying to get it run through DU or through AUS. All that is, it's their underwriting system that they use for Fannie or Freddie Mac. And so when they're trying to do it, they run it through the system. They put all their information in, like income, their household debt, things like that. And so what they're trying to do is they're trying to get an approved eligible on that initial system before they give you that pre-approval. And so, sometimes you'll see lenders who are like, well, we looked at, or they told us their income and we looked at their credit score and we gave them a pre-approval or a pre-qualification. Well, that's not as good as sometimes where lenders will actually run everything through DU to get an actually approved eligible. That's a lot stronger pre-approval than just getting, a verbal income qualification and credit score qualification. And then your lender preps the entire file with all this stuff before they send it over to underwriting. So that's why it's always good for your buyers to kind of have everything prepared going into it. Any questions? You can type it in the chat, or you can just blurt it out.
I am new, so I really don't even have any good lenders lined up. I don't know if that's something you feel you can share or.
Yeah. I mean, so actually what I'll do, sorry, give me 1 second.
Sure.
I'm just looking for a place to. What's your what? Oh, sorry. Go ahead.
I'm sorry, to add on to her question, are there some that you would not recommend?
I mean, I don't want to say I wouldn't recommend them. I think when you're looking at, as what your goal is, in terms of working with a buyer, and especially in this market, and who, we don't know how it's gonna shift or how it's gonna change. But I think at least when we were going full speed ahead these last couple of years, when you get an offer on a listing, people look at it, and you're going to sit down with your client. You're going to say, okay, we've got these 4 offers. So let's take a look and see what the amounts are, what kind of, what contingencies are they waiving on the contracts? What's the price? Do they have, any type of appraisal contingency where they're going to offer money over the appraised price? What kind of loan are they doing? Are they doing conventional? Are they doing VA or FHA? And also another question is, who's the lender? If I know the lender, or if I know that they have a good reputation, in this market, that does play a factor, I think. At least it does for me. Typically what's going to happen is you're going to see a lot of people when they're going to get a big bank, and I'm not throwing them out there because I've actually used them for several clients, but I'm just going to throw them out there because everybody knows them as Chase. Chase is not in the mortgage business. They're not in the business to be in the mortgages. It's something that they offer their clients as a service, but it's not their bread and butter. It's not something that they, I don't want to say they're not experts on it, but it's just not their forte. Whereas you go to a lender, I'm trying to think, one of the lenders that we always have come in, I think her name's Barb with Union Home Mortgage. She's been a lender for, I think, 20 or 30 years. It's all they do. It's all they do is mortgages. They don't do credit cards. They don't do, they don't do investments. They don't do checking accounts. They don't do, private banking. So with that being said, sometimes you're going to get, these bigger these pre-approval letters from these bigger banks. And I can tell you what happens sometimes is, they ask the people, how much do you make? And so you literally tell the bank, well, I make $75,000 a year. Okay, great. Do you know your credit score? Yeah, I think it's around 750. Okay, great. Based on those scenarios, we can get you qualified for this. Well, how solid of a pre-approval is that? It's not that great, right? And so if you've got a lender who gets all their information up front, pulls their credit score, collects income documentation and things like that, runs it through DU, the automated underwriting system, gets an approved eligible, that's a much stronger pre-approval than what you did the other person's. And so it does come into play. With that being said, I've had I had one where a buyer just recently insisted on going through Quicken Loans, and I was like, okay, let's do it. The lender, or the seller's agent, called me and she's like, have you worked with Quicken before? And I said, absolutely not. I will say they did a very good job. They kept me updated throughout the process. They had it closed in 21 days, or they had it ready to close in 21 days. I got emails constantly updated with where we were at in the process. So a lot of it's going to depend on how much due diligence your lender does up front. If they've collected, like my lender, my one lender, and most of them are going to collect a lot of stuff up front, their documents and stuff like that. My lender does a great job. Like I just closed I closed an OFA deal in, I think it was 18 days or 21 days. So that's pretty solid to get a deal done. So you just, if it's conventional from one of the bigger banks, I think you're fine. Where you start to kind of get a little bit more sketchier is if it's an FHA deal from one of those bigger lenders, which, more than likely they're gonna, with everything that's going crazy in the market right now, you're probably not going to see a lot of FHA deals because it's gonna be priced so high. It's just not going to be worth it. At least from what my lender's telling me. Hopefully that answers your question.
Thank you.
Yeah, and I can send and talk to Troy and to people in the office. I mean, Barb, what's your email? I can send you the lenders that I have that I know. I know Troy's probably got a bunch, and you go talk to everybody in the office. They're all going to use different lenders. They're all going to have different recommendations. But so that's where I think, and so what I do, just to kind of CYA, is, I give them like 5 different lenders, and I say, here's my typical lenders. You can use any of them. And obviously with us being part of Keller Williams, you really should be offering Keller Mortgage, because it's a great deal for your clients. They get, I think, $1,000 from closing, and they get, I'm trying to think, I think there's no application fee. So that saves them about $1,500, I think, typically on the application fees. So that's a great bargain. So, even if you have a relationship with a lender, it's always good to send. It's just like home inspectors. You always want to send your clients probably 3 to 5 home inspectors and say, here's a list of home inspectors. And you can't really say, I recommend this person or this person's good. I always tell people, send that list of people and say, here's the list of home inspectors I've used in the past. If you want to do some research on them, Google reviews and things like that. That's always good to do. But yeah, Barb, Barb, what's your email address? I can email my list over to you, and then obviously you can get some more from Troy and some other people in the office.
Great. It's just barbbailey@kw.com.
Okay. Cool.
And
Yeah,
with Keller Mortgage, is that all online? Is there a particular contact person that we use, or?
So actually, if you are in are you in the group on Facebook for consultants?
I believe I am, yes.
Okay. So I actually just posted this probably a couple weeks ago because I was looking for somebody at KW Mortgage. I'll have to find it, but Troy and Ashley and Ryan Conway all posted people who they've used from, and I think somebody else did too, and I can't remember who it was. They all posted who they've used at. So there actually is some people, I think actually they have an office in Dublin, I believe.
Oh.
I think, I could be wrong, but I thought I heard somebody say that. But I can send that to you as well, like a screenshot of those people with their phone numbers.
Perfect.
But yeah, so, it's always good to have that relationship with somebody local, right? Because
Right.
like my lender, he and I've been using them for the last 5 years. So, I do probably push more people to him than I would another lender, to Keller Mortgage. But, Keller Mortgage, is a really good deal for your buyers. And so you really should be sending them over there because it can save them a lot of money.
Right. Great. Thank you.
Anybody else have any questions or anything?
Are you able to send that list to me as well? All of my previous lenders I use are from Athens. So.
Oh, okay. Yeah. What's your email?
It's Robert Mack at kw.com.
Okay. Yeah. And, most of the lenders can work anywhere in the state. So that's the nice thing, is if you do have, buyers that are down in Athens, and you're not working down there anymore, but you can refer it obviously to a KW agent down there, and then get them hooked up with your mortgage lender. I know I've done that a few times with mine, and he really appreciates, even if I'm not getting the business, to send it to him.
Yeah, and most of them will like help out up here, but it's kind of beneficial for me to have, local lenders in 2 areas now. Because I'm based out of Lancaster, so I'm back and forth to Columbus and Athens as well right now.
Yeah. So you're in between all 3 of those places.
Right.
You're doing a lot of driving.
Yeah.
Yeah, that's cool. Anybody else have any questions or anything else that you might have?
No, thank you.
Your slide's going to be on KW Connect.
That's a great question. I got to ask Troy how to get those up. I sent them to Lisa Evelyn. I will email Lisa Evelyn and Lisa Montalvo and ask if we can get those sent out. I don't know if I need to make a correction on the one, but you know, really the biggest thing is check with your lenders on this, some of these things, because some of these things are going to change right now with how crazy the market is. And
Yeah, I
with
heard
lending.
Quicken was starting to slow down with some of their things.
Yeah, so they just announced that they're looking, well, that they're kind of looking. So I think on their servicing side, I think they're saying that they might need to get to borrow just a little bit, because I think they're trying to give people a little bit of a reprieve these next, I think, 2 to 3 months or whatever it is that they're giving people. So yeah, it's, you know, the thing is too is, and look out for Troy's emails because he's got a lot of stuff in there, but you know, they just announced that pretty much anybody that's got either a Fannie Mae or Freddie Mac loan or an FHA deal, which is probably 99% of the market, or I'm sorry, a government loan, which is more than almost probably 99.9% of the market. You know, if you're conventional, more than likely, unless it's some type of weird program that goes, like, you know, let's say you do it through a credit union and it's some weird offset non-conforming deal, more than likely it's going to be either Fannie, Freddie, or FHA, VA, USDA. Those are all govy. So, so more than likely, almost everybody's going to qualify for those, you know, these breaks or whatever that they're giving people. So, you know, don't tell people that. You know, they obviously need to call their loan servicers, but yeah, it's definitely interesting right now with all this going on. Anything else from anybody? No?
No.
I will, if you guys have questions, so I don't really use my KW email. I just use my personal one, or I've got a Gmail that's set up for work. Can everybody see the chat?
I
Yeah.
can't.
You can't? Well, I'll just give you my email. So if you guys have questions, you know, you can always call me, or you can email me or text me. I mean, obviously, you know, you really want to build a relationship with the lender, but, you know, this just gives you kind of a base understanding of kind of what the process is from your lender side, and kind of, you know, it's good to know just because, you know, when you're talking to people initially in your buyer consultation, you know, it's good to kind of know some of this stuff, because it helps you, you know, kind of peel, I always call it peeling the onion, but it helps you understand and to be able to find the root cause, or to peel that onion back and to get those layers, you know, because it might actually help, you know, get to the root of the issue, and you might be able to discover that, hey, you actually can help this person out, or you know how to help them out, or you know how, or you know where to send them to based on their situation. So, yeah, so I don't know if you guys have pen and paper or whatever, but my email, it's pflynn, and that's FLINN, realty@gmail.com. You can email me, at gmail.com. I just type that in the chat, and then my phone number is 614-499-0984. You can text me or call me. Anything I can do to help you out. Yeah, I'm here in Columbus. I typically don't work out of the office, regardless of whether there was coronavirus going around or not, but just because I have 3 monitors at my house, and so I really like having my screens in front of me to be able to do stuff. So it makes a huge difference from working off and I've got like my main laptop that I like to use, my MacBook, versus having to use my PC when I'm at the office. So, but yeah. So, well, everybody have a good day. Stay safe. If you have questions, text me, call me, email me. And then I'll check with Lisa and see about getting these slides sent out. And if not, you have a good day, and let me know if there's anything I can do for you.
Thank
Great.
you.
All right,
'Cause you
Thanks,
figured
Mark.
out.
Thank you.
Love that OSU slide.
Yeah, that's my background.
Beautiful, beautiful.
Yeah, I love it too.
Go
All right,
Bucks.
guys, have a good day.
You too.
See ya.
Uh,